Hey everyone, welcome in to another daily editorial here on the KE Report. Goran Chad here chatting with Joe Mazumdar, editor of Exploration Insights, which I will link to below this interview so all of you can keep up to date on what Joe is doing in terms of site visits, his thoughts on the markets when it comes to resource stocks, and maybe a little insights into what he's doing in his portfolio if you are a subscriber. Joe, I want to start off with something that we've talked about. It seems like for most of this year, at least in the latter half of this year, related to resource stocks, especially the precious metals stocks, it deals with the financing environment that unfortunately has been very, very difficult for a lot of these smaller and even mid-tier stocks. We're seeing it across the board where juniors are having trouble raising money for exploration. Development companies can't seem to get anything financed to start building their mines. And we even just had Kitco run an interview recently that really just said that the finance environment is dead. It tied it into the Canadian markets being dead in terms of how these companies raise money. But it did note that, look, Australia, there's a lot of money being raised over there. There is a different makeup of investors over in Australia, especially with some of the different fund mandates over in Australia. But let's start here, Joe. Your takeaway from the Canadian markets when it comes to financing exploration or really any resource companies, is it dead in your eyes?
The sentiment definitely is neutral to negative. I mean, I just bring it to neutral based on the recent fervor last week where gold popped, almost I think to an all-time high. That definitely helped, and I'm sure if that window was open for more than 3 days, a lot more people would have tried to jump into that window and finance, but it wasn't long enough. So definitely in the junior market, especially for precious metals, it has been this whole year, like since I bet, since March, I guess, has been fairly negative. And having money, matters with respect to drilling, with respect to doing anything, with respect to catalysts and news flow, so on. Unless people are willing to have a 2 to 3 year commitment for some of these companies, it's hard for somebody to think that somebody would take part in a private placement or buy your shares. Right now, people don't, they need people to buy their shares to get the share price up. But really what they need to do is raise money because obviously they don't make money. So either you go to a strategic, do a project earn in, like some companies that are in the portfolio have done. What gives me comfort, even though they are diluting themselves with respect to the numerator of the project, they're not diluting themselves or putting themselves at risk of dilution from the denominator, which is the equity, because they might not be able to get that equity when they need it. And also, the way they plan and the way they do exploration is much different in that when they do a drill hole, it's 5,000 meters, they need to have that intersection that they can go to the market with. If they don't hit it, they're basically done. But if you have a major there or a strategic there, you could say, well, that was actually quite interesting. It's got the right alteration. Didn't get the grade, but maybe we should drill over here and do some more geophysics and some more groundwork. Great, let's do that. That's easier to do when you have that backing. Much more difficult to do if you don't have that kind of backing, especially in this kind of volatile market. And then there was a graphic, I think, in the Globe and Mail about 3 or 4 weeks ago showing the ASX market creeping up and almost beating the money raised in the TSX. And I think we've talked about this before, the amount of funding by IPOs on the TSX Venture is almost down 80 to 90% year to date. And we've had probably a 35% drop in the total money raised on the venture. So everything that we're thinking about in terms of negative sentiment is definitely reflected in those numbers and is reflected in probably a news flow and reflected in sentiment. It's definitely not reflected in the amount of conferences out there that people attend. I talked to a few companies and, some of them or several of them have been traveling Europe for the last month at this melee of conferences over there, whether it be Switzerland or London or Germany or whatever. I'm not sure if they got much love out of that, But I mean, that's still money that they're spending that they'll have to go to the market to replete.
Well, Joe, this brings up an interesting dilemma for the smallest juniors that maybe have put out all their news from last year. They've put out all their drill holes or all their targeting, and they don't really have a way to raise money without it being incredibly dilutive to existing shareholders. And maybe they do have the prospect of bringing in a strategic, maybe they don't. We've seen some companies also selling what they're now calling non-core properties, but a year ago, these were properties they were very excited to have in their stable just to keep the lights on. But on the development stage companies, they have one other layer, and that is they could do a deal with the royalty or streaming company, or they could look at debt as part of their project, or somebody maybe buying early pounds or ounces in the ground ahead of time. Out of all the different poison pills they can take, I guess, between dilution through equity, dilution through bringing in a strategic, dilution through the royalties, or dilution through, getting rid of some of the projects in their stable, which one do you think is the better fit for companies that are maybe of the development size?
The development side, the perfect win-win situation would be to take a byproduct. If you're a copper project or a base metal project and you've got gold or silver credits, to do a stream on those specifically because they're less than 10% of your gross revenue. Your investors care less about that part of it, and they basically account for it as a byproduct credit that goes against your costs. So basically, you're fixing a cost, a positive cost, let's say. That's a win-win. That's an easy one to do. That for me is the first thing you should consider if you're a development project. Like somebody like Generation Mining, a palladium copper play in Northern Ontario. I think it's permitted now. They're raising money. They have a debt facility, but for them, it's hard to get equity. But the streamers, your Wheaton Precious Metals, and these sort of companies have cash, and they're willing to take advantage of this market. It's them, it's private equity, it's strategics that will take advantage of this market and advantage of these companies, especially who have underlying assets that they think have value. Because the problem is that if you don't have a bid in the equity markets, is that, oh, well, I don't want to do a project earn in because I can go to the equity markets and get that cash. Now they can't. And so those guys can sit on their hands. They could wait longer than you would prefer them to wait. I went to a project in Idaho and they drilled a really good copper hole and they had so many companies looking and checking their project out. And then they ended up doing, strategic private placement with Barrick at a significant premium. They got the cash they wanted. And because there was so much demand to learn more about the project and to help them, they didn't want to do a project earning. They just wanted to do equity. And that's a very bull market sort of sentiment in a decidedly bear market. And it can be very project specific. So if you got a project that everybody's interested in, you might be able to get a bull market level financing out of it. But if you've got what everybody else has got and your comparative advantage is like nothing, and you basically need a change in sentiment, that's a harder sell right now for the equity markets to consider, hey, pick me over those guys. People are very much, they're very focused on who has a heads up or a comparative advantage over other people. And that might be jurisdiction, that might be grade, that might be more infrastructure, that might be management, whatever it is. That's what people will continue to seek in this market because it's not a beta market right now. It might change into a beta market if real rates keep going down and everyone's convinced of that pace. It will change to a beta market, but it's more like an alpha market right now.
Yeah, focus on the higher tier projects. Fact of the matter is, there are so many projects out there. But then, Joe, how do you view this much wider swath of projects where, unfortunately, again, a lot of these companies are still struggling to raise money. They are watching their money much more closely, which means lower work programs, less drilling, less development. And a lot of what I'm hearing is more focus on economic studies, more focus on surface work, more focus on permitting. Doesn't sound overly exciting, but how do you view, unfortunately, what these companies are being forced to do, or at least message for next year?
Well, I think that anybody who like strategic, meaning a high net worth investor, like if they can point to, hey, 6 or 7 people own 50% of my shares, those would be the people that say, oh, you know what? I also own, this same group owns 50% of these shares. And so we'll still see consolidation amongst juniors like we saw with, I think it was Adventus and was it Luminex or
Yep.
Lumina? Okay. Yeah.
Luminex.
One of those two. Yeah. To say, hey, you're both in Ecuador. So we don't have to convince anybody about Ecuador here. We don't have to say, oh crap, you're in Nevada and then you just took this Ecuadorian asset. No, they're both in Ecuador. And so anybody who doesn't like Ecuador is not in either company. So you don't have to convince them of Ecuador, but you're sort of saying, okay, let's consolidate this, lower our G&A, and prioritize where we're going to put our capital. Because now combined, we have more cash. And now we can put more cash into that first asset, whatever that one happens to be. And I think that's what's got to happen right now is that we've got to cut this G&A, the expenditures, because raising just for G&A is not on everybody's hit parade right now or ever was. The consolidation is important. And then more, as importantly, the prioritization of the portfolio to say, hey, which ones are we going to pick to go forward? And that's what we're going to focus on. Now we have more cash to do more things with that project, and we'll leave these other ones aside and, maybe we get rid of them later. I mean, the other problem right now is the M&A. So, a lot of these development projects are like very cheap, very inexpensive, but we're not seeing as much M&A as we'd like. Like we saw Marathon, we talked about that one last time. But that was like a 30% premium off of a 52-week low. That's not very encouraging for people, but that would be great for the intermediate to come in. Are we going to see more of that? Some people don't want to do that, so they'll try to hold on as long as they can for a more positive sentiment before they get acquired. So I think we'll see more M&A, but another thing that's happening in the M&A space that I think we talked about previously, which is now coming into the fore, is the Newcrest Newmont merger and all the assets they have that they're going to look and prioritize. So I was in the Yukon, and my impression is that not Kaminak, but Coffee Project will get sold now. It'll be back on the market. Those are the sort of projects, development feasibility stage projects or in some production that'll come on the market that some of these intermediate producers are waiting for to say, oh, these things are going to come on. I'm not going to do anything until I know what's the other side of the menu is going to come. I want to know what the special of the day is, that sort of thing. So that's something I think people are going to look at. And that's once that's out, and it's probably already sort of coming out now, is then we'll see who's really big in M&A, because a lot of these intermediates are going out of one capital cycle and probably looking for growth, because that's what intermediates are more about. They're more about growth than paying dividends. So, there's a lot of projects out there. And so M&A should be a nice trigger for that, change in sentiment, because then they want to get ahead of the gold price. Because if they wait too long, those projects will be twice as expensive.
Yeah, Joe, that's some interesting points as far as a lot of these intermediates waiting to see what is on the menu from the Newcrest Newmont merger. And there's even some other majors that may still divest some what they consider non-core projects. So before they start acquiring the on sale rack development projects that are on the menu now, they're waiting to see what else is there. But I guess it begs the question of what a lot of these companies can actually do moving forward, because some of them have been waiting to get bought out since the last cycle, and they continue to say, hey, we're a great takeover candidate, but they're hanging their hat on that, and sometimes there's not much going on with those companies. In your own portfolio, how are you managing the current lay of the land as far as this financial drought that a lot of companies have? There's the story of the haves and the have-nots. Some companies have exciting work programs this next year. A lot of companies don't. How are you managing that in your own portfolio?
Yeah, some of the companies that have done well, the few, have been basically in the portfolio, but uranium leverage to uranium, which has turned a bit. It's gone up to a new high, and a bit on the lithium exploration, especially in Quebec. That's been a lot of momentum behind that. Copper has come and gone with respect to leveraged producers, but most commodities haven't done that well, partly because of China. And the gold obviously hasn't done well because of rising real rates, which might be turning right now. So the problem is, like we've been talking about for the last half an hour or whatever, is financing risk. And so the changes in the portfolio had less to do with the technical knowledge of the people running the companies, because that was pre-filtered and that's why they got into the portfolio. It was more about very expensive exploration in a very weak financing market that that I'm worried that they'll the next raise will be really a lot of shares out. If they get it, and if they get it, it'll only be 1,000 meters or 2,000 meters that they'll be able to drill. They won't get enough money for that 5 to 10,000 meter program that they dream that they want to do. So you will get less catalysts, short windows of time with the field season. So I'm more adding companies that have money, have drilling already set up, permitted, ready to go, and are trading not quite at cash, but with very low enterprise values of 10 million or 15 million. But again, all the same filters: good management team, good project that I've seen, good jurisdiction, because obviously with the jurisdictions that's becoming more of an issue with what's happening in Panama, and the background risk, whether it's real or not, with Guyana and the Essequibo region and Venezuela. So that's the trade right now, is those ones with everyone's got financing risk, but I see a bigger problem with remote projects where they're spending $1,000 a meter to drill, and going to the markets and saying, oh, give me whatever, but I'll only be able to get 1,500 meters out of this, versus another project that could get 5,000 or 10,000 meters of drilling with the same amount of money. But I'll say this, and we talked about this off air, is that all the drilling costs have gone up. In the Western U.S. right now, it's like $400 per meter U.S. all in. That's a lot of money for, no helicopter, road access, not far from a town. And easily the stuff on northern BC and the Yukon on Canadian wise is over 1,000.
Joe, are there a lot of companies out there that you're finding that actually have money and actually have a decent work plan outlined in front of them? Because honestly, I'm not seeing a whole lot of them out there.
No, you got to read the letter. But yeah, yeah, no, there's not a lot. There's not a lot. And so, it's usually people coming to me and saying, hey, have you looked at this one? And while I was on one conference, an opportunity came up to look at a project. And then I knew the geologist in another life, my same life, his different life. And yeah, I like the project. I like the people. I like, the fact that the senior geo, the VPX, actually lived near site. And that's another thing that's important for me now, because with all the ESG issues, the social license to operate, that's always existed in mining, but it's obviously come more to the forefront now that everyone's looking at it. It's good. And with, what happened with COVID, it's good to have senior people close to site, at site. So you get local knowledge. You're constantly talking to the communities. You know what's going on. You're not just flying in once or twice a month. And so both these ones I added, that's the case. That at least the VPX or the president of the company lives close to the operation.
Well, Joe, just one more follow-up on the point you made about the alpha stocks versus the beta stocks. We've had that discussion with a few people on the show, and it's interesting that sometimes when the worm turns in the sector and when we really see some momentum going to the upside, when it becomes a rising tide lifting all boats, it's the turkeys that fly. It's the pigs that fly. It's some of these companies that are considered optionality plays. They have ounces in the ground. What are your thoughts on optionality plays and the re-rating that they can get in a better environment?
Well, absolutely. I mean, so leverage plays, we were talking off air again about this, a new subscriber I got, and, his firm or his group had about $100 million to invest in the sector. And I thought, oh my God, where did that money come from? But anyway, that they were thinking that the sector was undercapitalized, which it is, undervalued, which it is. and they were looking for a turn in precious metals, and they wanted leverage. So he specifically asked me about projects that were on the cusp with respect to all-in sustaining costs. He didn't want the ones that had the big margin. He wanted the ones that were at the money with respect to what they were doing, because that, as he knows, and we all do, is that's the ones that have the biggest leverage. It all depends the kind of risk. If you really believe that gold's going to turn around next year, then what I did in the letter is I took a look at it, and Ron Stewart, who's got this consulting firm called AUCU, Gold Copper, he does these all-in sustaining cost graphs that he plots versus valuation, EV per ounce, and you could sort of see like, okay, who's the more expensive ones and what do they have with respect to costs. And you could pick that, okay, well, these are the ones that might be good leverage. But when you do pick leverage, you don't want to pick geopolitical risk. So you'll pick somebody that's high cost, but you want to make sure they're in a stable jurisdiction. If you're going to pick somebody in a very shaky jurisdiction, do not pick the marginal project, because you're going to get the margin, you're going to take all that risk, but also you're going to take the geopolitical risk on top of it. So if you're going to take one that has geopolitical risk, get that one with the high margin, get that one with the highest quality. Don't try to do that one as a marginal asset.
Very interesting there, Joe. I think we're going to wrap it up here. We've talked about a number of different aspects for this market, and look, a lot of it still, unfortunately, right now is coming down to financing. Make sure companies have money, or especially even if they have some major partner, some major company that gives them a longer timeline to plan out some more significant work, because, well, at least right now and for the last while, it's been a tough environment for a lot of these smaller companies and even these developers to lay some groundwork and timelines to move forward on, simply because cash has been so restrictive. And to your point, drilling costs have gone up a lot. So, boy, oh boy, just trying to explore has also gotten more challenging from simply that financing environment. Joe, thank you as always for your time. It's great chatting with you. As I mentioned, I'll post a link to the Exploration Insights website, and we'll be chatting with you in the new year. So, Joe, thank you very much. I hope you have a very happy holidays, and let's hope 2024 is a bit better for a lot of these stocks.
Yeah, there's always hope. Not a great strategy, but there's always hope. Merry Christmas, guys, and we shall talk to you later.